he told me he graduated, so I thought he was 24.
Could have graduated earlier, right?
I have to look at his resume. So we see, matter of fact, at Kick Labs we sponsor a group called Teens in Tech, and these young guys are starting companies really, really early. So with that in mind, just a question maybe for you, Ann, is that a barrier to you at all when you're looking at an investment?
You know, one of the things, and I think Paul alluded to this, is that you really have to be open-minded to be an early stage investor. If you have if you sort of already pick the markets you like, you know, we don't get to pick the future. The future comes to us. Second is talent can be found anywhere, and John Hummer was a first-round draft pick in the NBA, you know, out of Princeton. That's an unusual combination. But most of the entrepreneurs that come to us, you know, don't have any sort of a lot of experience before they've built companies. They may not have any pedigree. The same is true of Josh. You know, what had Josh done before Amateur?
Not much.
And what can Josh do now? Anything he wants to. We just gave a term sheet to a 19-year-old founder. And he did graduate from high school at age 14 and college at 17, and already had 2 years in the workforce. And he had one other attribute. He said if we wanted to go out and celebrate the closing of the round, he could actually have a drink because he and his 21-year-old brother looked identical, so he had his ID card that he carried with him at all times.
And the same thing too, yeah.
Yeah. So, you know, I mean, he had a lot of chutzpah. So, we're looking for natural athletes, and you know, we really want people that are very agile, and you can be agile at any age. But if you sort of think there's a playbook for how companies exactly work, how your product will exactly be built and exactly what customer wants, you're not really set up to do a startup. You really have to have a lot of agility, a lot of openness yourself to building of your own team, to the marketplace needs. You have to be an extremely great listener and an even better communicator. And this goes back to Josh James, who is the founder of Amateur. This guy is one of the best communicators that you'll ever find. Basically, we could have given him, you know, like a description of a raw company and said, build one, you know, and he could attract the talent, number one. He had the ability to attract excellence, which Paul talked about. He had the ability to listen carefully to the customer and talk to the customer in the customer's language, having never met customers before. Really unique natural athlete skills for a startup.
It's funny too, because when we made the investment, he had a company, his first company was called Superstats, and it was a little, if you remember the day when there were little trackers at the bottom of web pages, and we really thought, you know, this company is going to be okay, but we figured if this fails, we'll stick with him because one company he starts is going to be successful. Little did we know it was going to be that one. And by the way, that young 19-year-old, before we invested in him, I took away that ID just for liability purposes. No, just kidding. No, we're also invested in that company too.
So another thing I'd like to add, I really feel also a lot of entrepreneurs now are a little bit more educated. It feels like there's a lot more information being disseminated out there. I mean, there's a lot of great blogs, there's a lot of good information about what should be in a term sheet, what is a good way to negotiate with your potential customers. So I feel like there's a lot more information out there to starting an internet or kind of software company than it was even 5-10 years ago. And I myself feel like there's so much more information. When I started my first company, I was clueless. I had no idea. I was kind of fumbling around. So it seems like there's just a lot more, there's like a lot more inefficiency back in the day, and now you're like, well, I know this, I can avoid this, so can I get to the meat and potatoes of the business faster? And I don't know if you guys are seeing the same trend or not.
Yeah, but I think there's a lot more transparency in the business, and I think that's a great thing. You want to establish trust between the entrepreneurs and investors, and I think that's how the best board dynamics come about. And so I think transparency around terms, around how you're going to work together, and having a clear expectation about what that relationship's going to be like is best for the company.
Yeah, I think that what it's like in the start, is sort of everybody wants to know, and people ask you what social graph you're on. We're all on the same social graph now, all 600 million of us. But what isn't known is once you actually get started, there are a lot of really challenging things. Our whole industry is bad at pricing products. Now, we know how to give them away for free, and we actually know how to actually seed markets much better than we've ever known. So that's becoming, the marketecture of companies is becoming much, much more sophisticated for all companies. But things like your pricing strategy, your compensation plan for yourself, your employees, your salespeople, you know, one of the things that we sort of assume as an A-run investor is, hey, the entrepreneurs are more knowledgeable here, maybe they'll be more knowledgeable here, here, and here, and guess what? They're not. There's a lot of stuff that, even if you go to business school, there's not classes in this stuff.
You make it up as you go sometimes.
Yeah, and that's the reason that, you know, you really do want to have an experienced board. You want to be in a set of companies that are at about the same stage, working with them. You know, we cross-pollinate our marketing teams from one group with another group. We find the best CFO in our groups and say, okay, this company doesn't have a CFO, or go help them hire one. Because there are a lot of ways you can fail once you start operating. And those are really the failure points. They're not, you did a bad term sheet, or they're not, you know, most people don't feel like they picked the wrong investor. You know, because it's a hard thing to do anyway. And as Paul said, we sort of pick you as well. You know, we only can fund so many companies, so we're not going to pick people that we don't like. We're not going to pick industries and opportunities that we're not passionate about, because life's too short. But the failure points come much, much later, and that's where it's really important for you to sort of figure out how you build the employee dynamics, the investor dynamics, the board dynamics of your company, so you can reduce the risk that you can actually flourish as a whole company in case you don't get acquired when you have only 2 people.
So Naval was here in the morning. I hope most of you saw Naval, and what he's done over the last year with AngelList is pretty phenomenal. You were talking a little bit before about sort of stage of investing. AngelList is sort of democratized from an investing point of view or investor point of view, and it seems, I get this question a lot, is like, who do I talk to and what stage? And Andrew, I know batteries come down to very early stage now, so maybe you can talk a little bit about that and how you're evaluating things as you go through, because you're really stage agnostic at this point.
Sure, yeah. Battery has been doing early stage investing for a good long time, and I can think of some, even within enterprise, some great founding investments we've done in companies like Akamai and Blade Logic. I like the benefit of being in a stage agnostic firm because, one, there aren't these allocations. It's not like we've dedicated, you know, small fund within a big fund to do only a certain kind of investing. I think we let the market speak and we follow those trends. The nice thing about having an institutional investor, I think, from early on is you can have the benefit of having that investor stay with you, you know, throughout the life cycle of the company. And when I think about, you know, I thought, you know, one of the sort of hotter topics of discussion were around maybe the differences of you know, an angel investor versus an early stage venture investor. I think it just depends on the partner with whom you work too. I mean, for me, having recently come back to venture, I've got a lot of time to spend with entrepreneurs. I can get on a plane and go visit a company, and I find that some of my partners and friends at other firms get very busy, you know, sitting on 8 or 10 boards, and so I think when you're choosing a partner, it's important to consider that as well.
And the expectation of, you know, Paul's had some exits. Obviously, the amount of investment in the company has been relatively small.
Yep.
So the exits have been relatively small.
Yes.
So I think each of you probably have different expectations from an exit point of view. Can you talk a little bit about that?
For us, obviously, we want the companies to go long term and go big, but it's not going to be a good fit for every single company. So if it's like, you know, 3 guys and they see that, you know, they're going to be valued quite well for what they built in 6 months, and I mean, we put in good money, I mean, small amounts of money, and like, you know, with pretty good terms. So if the numbers work out, we're fine. So we understand that we're investing in, you know, 10, 15 companies a year. That not every single one's going to go all the distances, going to go, you know, 5, 7 years out. Some of them will fail, but yeah, there's 1 or 2 that need to exit really early. We're really cool with that. It's also, it's our personal money. We have no other money in from like professional investors, so like the returns that we expect are much more different as well too. And we own all the kind of upside, I guess. So we're pretty open to anything like that.
Well, the truth is that more companies are acquired, especially today, than go public. And the destiny of yourself depends upon if you've got a quality product company to even get. Companies are bought, not sold. And I'll give you a good example. Andrew was at VMware. We had funded a company called Kimby, and it was building to oversimplify it, a test and dev environment for VMware's platform very early. And the company had a small A round, which we led, and they had just closed their B round, like days, maybe months before this. And we were very excited about how the company was doing. And the company seemed to be excited about that too. So VMware went direct to the company, not to the investors, and said, hey guys, we'd love to acquire you. And, we're gonna slap down kind of an interesting number for the company given, even relative to the venture investment. So my partner, Mitchell Kurtzman, shows up at the board meeting and the team says, hey, we just got an acquisition offer from VMware and we want to take it. Now, in this case, it turned out that it was a good offer for all shareholders. But if it had not been a good offer for all shareholders and the entrepreneurs wanted to go work at VMware, the company would still have been sold to VMware. We're not the intellectual capital working day in and day out at those companies. The entrepreneurs are. So it is rare that a company where everybody's happy around the table, doesn't get a lucrative acquisition offer. And this acquisition offer was higher because there was venture dollars in it. Today, and that was probably, 6 years ago? 5?
It can be.
It can be?
Yeah, I would say it's about 5 years ago.
5 years ago, all those guys are still working at VMware. So
yeah, I think it's a great example, and you would think there might be a misalignment of interest for that last money in from that investor not being able to see the vision out through its fruition, but I find it's really rare. I mean, I can't think of a case where an entrepreneur's been a portfolio company of batteries or otherwise has been really motivated to sell because they feel like there's an opportunity at a big platform company to get even more funding and more distribution and seeing their product really get widespread. And it's hard to kind of unnaturally get people to do things that they don't want to do.
Mm-hmm.
I think there are flip cases too where, VMware is another great example. I joined in 2006. The company had already been sold to EMC, but not yet taken public itself. Diana Mendel sold the company for a little over $600 million, and there was a significant amount of equity value there for some of the early founders who were graduate students at Stanford working with Mendel. It's a $30+ billion, almost $40 billion IPO, valued company in the public markets now. And so there are opportunities too where you think this may be your one opportunity to build something really great. Why sell early? We can give you the funding to actually see it, get that widespread. So it really just depends on the case and the example. But I rarely find a misalignment even between investors. I think, we're about to sign another term sheet on another company, and we're working with an investor that's more used to doing small investments, early stage, and they had this concern: is battery going to hold back a sale of the company because the return profile is not high enough? Whereas for us as a smaller investor and doing mostly angel-style investments, it would be. And again, I think we give a lot of comfort, both in the terms to show that we wouldn't block those kinds of things, but also sort of spiritually talking about it and saying we're very aligned with founders here, and we want them to be happy. You just can't force the unnatural.
One thing we like to say to our companies, because we're always asked, especially by the younger entrepreneurs, what if we would get an acquisition offer? And we say, what a great opportunity for you that you could say yes or no to being purchased by someone else. And all good companies get acquisition offers. So you want to create enough value, either by claiming the market first, by building the best product, by owning all the customers, by having the deeper IP, that you are viewed as valuable by your industry.
So to dovetail that thought, a lot of your entrepreneurs out here potentially raising money, valuation is a question. So there was a quote, Paul Graham is pretty free with his opinions, and he said the other day, who cares about valuation? If you're sure it'll be good, nothing should be too high, okay? So, what are your thoughts about valuation when you're looking at investment? And is that